Hi, my name is Caleb. I am starting brand new with a blog. I figure everybody else is doing it. Basically, what this is going to be called is Dumb Dad, Poor Dad. I'm a student of Robert Kiyosaki, so I feel like I'm the opposite of everything that he is. So that's where the name comes from. I'll actually have another person joining me at different points throughout this. One of us will be the dumb dad, one of us will be the poor dad, and it might be interchangeable. So that's kind of where we're at with it. Not only am I a student of Robert Kiyosaki, but I'm a student of Andy Tanner, who's part of the Rich Dad family. Like Andy Tanner, I follow a lot of what Warren Buffett does, and I'm also big into Benjamin Graham. I think both of them are misunderstood. Over the years, I've seen many people conjure up what they think Benjamin Graham and Warren Buffett must have thought when they purchased this stock or that stock. Their interpretations of Buffett's letters to his partners and to his shareholders, they try to interpret it the best that they can, but sometimes, I still think even the most loyal people to Buffett oftentimes misunderstand him, and I'm likely to misunderstand him as well. You know, when they talk about owner's earnings, they say, well, he must have meant this, and some people say, well, no, he must have meant that. Phil Town is somebody else that I follow quite a bit. He was the first person that really put me onto value investing. I really enjoy a lot of what he does. His podcast is the Rule One podcast, and very, very enjoyable to listen to, especially if you're just brand new beginning. And Phil Town does a good job of giving, doing a fundamental breakdown, and I kind of find myself gravitating towards that. I really do enjoy quite a bit too with technical analysis, but I use that kind of as a tool to help after I've done my fundamental analysis. So Phil Town makes an excellent case for what he thinks Buffett's secret sauce is, or what he's really the only person, like I said, who's gotten me interested in those two geniuses. But I think he misses the mark. In his podcast, he plays a clip of Munger saying something about it's easy, but not everyone does it. I know that they were looking for a few excellent companies. Graham was looking for just cheap companies that might have a couple more puffs left in them, and so that there definitely is some differences there. But I think the overall premise of Graham is being followed by Buffett and Munger, and I think that a lot of people miss the point on it. And again, I'm not saying that I know what they're thinking. Obviously, Graham is no longer with us. It'd be hard to get the conversation with Buffett or Munger to even find out where they're thinking with it, but I think the thing is with Graham is we have his books, and there are things that he says in there that I think give us some clues as to what he does. Nobody has had the success quite like Buffett has, especially just in the stock market. Phil Town talks about free cash flow as a success to the stock, and he has a formula for finding out what the price of the stock should be based on free cash flow and if it's a good deal or not. I do agree with that. I look at it quite a bit. If the company has negative cash flow, I don't really want anything to do with it. So I do pay attention to that. Dan Ferris is somebody else I follow as far as value investing. I've not seen anything that he's ever recommended, but he's got a podcast on the Stansberry Investor Hour. I've read some of his articles and things like that he's written. In my estimation, he's similar to Town. And Phil Town in that he talks the Porter Stansberry line of capital efficiency, but as capital efficient as a company is, that in itself doesn't do it for a part owner of a company, at least in my summation. Andy Tanner may be my favorite. He says if it doesn't pay at least a 5% dividend, he may not be interested in that company. I know sometimes he changes kind of the value on that. So free cash flow is great with capital efficiency. I like those things in a company. That's things I want to see. But if that's the only thing, then that doesn't work for me as an owner personally. If those are owner earnings, then what do I have? I don't have anything other than a piece of paper that says I own a stock. I'm not making any money off of that. Starbucks is a capital efficient company, but they pay 2.26%. American Express is great as well, but only 1.2%. Companies are capital efficient as well, like Microsoft, Apple, Google, Amazon. I don't shoot the messenger here, but Microsoft, Apple, Google, and Amazon are, that spells MAGA. So if you don't like that, you can tune out, but pay 0.87%, 0.51%, 0%, and 0% respectively. So they're capital efficient, but they don't pay any kind of dividend at all. So I'm glad for efficient companies, but as an owner, if I get 0% of the earnings, who cares? Who cares if you're compounding free cash flow if I've got nothing compounding in my... So wonderful capital efficient companies, but they do nothing for the owners, at least not very much. Apple does do stock buyback, so that does help a little bit there, but again, that that doesn't do much for my availability and ability to bring in more cash. So how do we decide what an actual owner would earn? What would we look for in a stock? And I think free cash flow and capital efficient, like I said, those are great ways to start valuing a stock. But Graham talked about companies at a wonderful price. Munger talks about wonderful companies at a good price. Free cash flow and capital efficiency gets you wonderful companies, but how do you determine what great or even good price is? So I think that's where we looked at Graham. I think we can look at Graham. What he said in Intelligent Investor, bonds should be purchased when the yield is greater than the yield of stock. So what that means is the bond yield is like right now we've got bonds over 4%. You can find individual stocks that pay a dividend of higher than that. And so you can buy bonds right now. I think if you're buying indexes, the S&P 500 is paying less than 5%. So at that point, you probably would be better off investing in like a TLT. And I'm not saying that you have to invest in anything. I'm just saying, like, if you're looking at based on what Graham was saying, is that you buy in what pays the best yield. And I think that's the piece that's being missed in a lot of this, is that yield, because that pays cash, which is, as Yogi Berra said, is as good as money. But if bonds yield more than a stock, then you should invest in bonds, is what Graham is saying. And if the inverse is true, if there's better yields on stocks, then you should invest in stocks. And I would say for the longest time, over the last 13 years or so, it's definitely been the case where stocks were paying a higher yield, and that's why we saw a lot of the stock market go up, because people were chasing yield, and that was the only place that they could find them, not in bonds like they had been historically. We're here over probably like 4%, I think, on average, maybe a little bit under. If the stocks you're looking at or yield less than the bonds, then you shouldn't touch those stocks. If you're in those MAGA stocks, like I talked about earlier, Mike, then you want to make sure that you're not getting that yield that's higher than the bonds. Even on those longer term bonds that have lower yield than the shorter term bonds, they're still yielding better than Microsoft, Apple, Google, and Amazon, especially at the current price. Now, they're wonderful companies, but an intelligent investor would not say that they're great, nor are they at good prices, because the yield is low for what you're getting. And so I think that the yield is perfect, and I think that's where you see the best price is when the yield is higher. That's the higher the yield. Now that's not always the case, because if they can't afford to pay their bonds, so that's something, or their dividends, and they're taking it out on loans that have a higher interest rate than what they're paying out. There's things to look at with it. So that's not just it. So you're doing a full analysis of the company. So you have to look at those companies as, okay, are they paying a great dividend, but how do the rest of their fundamentals look? Why does the dividend yield matter? It's money in your pocket. That's actual money that the owner earns. So we talk about owner earnings. That's, to me, that's what I'm thinking yield. Now for Buffett, with him owning a ton of Apple, even his little 1%, he's still making quite a killing on it. But it's really the fairest and fastest way to compare bonds to stocks is just looking at the yield. And I think that's one thing to definitely look at. Definitely doesn't do any good if a company tanks on earnings and then they're saying, we're going to have to cut our dividend, or, they keep the dividend high, but they don't have the earnings to support it anymore. So there's different things with that to look at. Bonds are neither efficient or inefficient. They just, they're paying bonds. They don't have free cash flow. It's just, government money, lending to the government. So I guess there's owner's earnings, but so you're owning a piece of the United States, I guess, if you look at it that way. Now, if you're a buyer of indexes like SPY or equivalents, if that's your cup of tea, when I wrote this, the dividend yield for the SPY was 1.39 versus the 3% plus of a bond. Better for you if you get a 1-year bond right now. But wow, if you can lock in that 30% for 30 years, that's not too bad compared to compared to the S&P 500 or the SPY index. And when the SPY index, you're paying fees on top of it, so you're not even really getting that 1.39%. But you don't even have to go to the open bond market. Like I said, you can buy bond funds. There's plenty of those out there. TLT is one of my favorites, but there's other ones out there depending on what you want to do. There's obviously leveraged ones, and you can buy option contracts against them and sell option contracts against them and things like that. So there's, that I think that's why TLT is one of my favorites, just because it has that liquidity to it. And it has a ton of option contracts available to it. But if you want to go right to the government directly purchase them, you're still getting that same return. But based on that alone, index traders, being Graham-style investors, intelligent investors, they must consider TLT as a better option than SPY right now, because because you're getting that yield. I don't think Graham would buy SPY. Maybe he'd buy TLT. I don't know. But if he were to buy individual stocks based on their yield being higher than the bond rate, he'd do it every time. And Buffett would too. If it was between those two things, I can see Buffett going for the yield. Every time the market tanks, I have a little laugh at the talking heads in the financial media. People I normally have a lot of respect for, even if I wouldn't trade the way that they do. But for example, in March of 2020, Buffett takes a huge hit on the airlines, and everyone's concerned about what does this mean for Buffett? Is he losing touch? Does he even know what he's doing anymore? That's a lot of money lost in airlines. But they're all looking just at the current stock price, and they're forgetting a lot of the other things with that. The stock price only means something if you're buying or selling. If you hold it, it means nothing to you. The thing that's interesting about Buffett is most of his money is not made on those stocks that he owns. No, he doesn't own Coke because they're a huge growth company. He owns them for the dividend that they pay, but most of his money he makes on companies that he owns outright. And it's basically like they're paying a dividend to Berkshire Hathaway or to Warren Buffett. And so when you look at, okay, is he losing touch? Well, no, because he's still making a killing on the companies that he owns outright that he's not selling. It doesn't matter what their book value is or anything like that because he's not selling them. He doesn't care. They're just producing cash flow to him. And that's a higher yield, especially when you own them outright and have for years. They've already paid for itself. So that's where I'm thinking that he's in line with what Graham had said in his book, is that if the yield is higher, well, the yield is higher in the companies that he owns than in the S&P 500, any of the stocks that he owns. Maybe not Coke. I think he's owned that long enough now. There's probably not any, his cost base is probably less than zero at this point, but if he's selling covered calls, so that's where I think when you're collecting dividends on Coke or collecting dividends on a company that you own outright, you don't care what else is going on except save the narrative if it's changing for that company. It's Starbucks, and I said it pays a shade over 2%. An intelligent investor would rather buy bonds at 3% than a dividend at 2%. Prior to this year, this past 12 months, I would say that bonds were a little bit more stable. They weren't going to drop a ton, but we saw, with all the tightening of the credit markets and everything, that's definitely pushed the yields up, but the bond price is down. It's gone down. I think about a third of their value. I think they're around 150 for TLT, and it's gone down to right around 100 right now. But what if you could turn that 2% into 14%? Well, how in the world would you do that? Well, for instance, you could sell monthly options on Starbucks and net 1% per month for 12 months. That's 12% annually, plus a 2% dividend would be 14%. Nothing like that's going to ever be exact. They could cut their dividend. Right now premiums are really cheap just because there's not a lot of volatility. The market's been going sideways for a while now, and so things like that could happen. But then we could have a spike in volatility, and all of a sudden now we're making a little bit more than 1%, so we can make that back. So that's just kind of a guide. I'm not suggesting buy Starbucks. I'm just saying there's ways to kind of make that to be better. That would take you just over 5 years though. On that 14% to bring your cost basis to a zero. Now, I'm only using Starbucks again as an example for educational purposes only. This is not a recommendation to buy Starbucks at its current price, or at any price for that matter. And again, I wrote this before, and I'm just kind of reading it to you now. So the price has definitely changed since then. I just looked at it the other day. It's definitely higher than it was when I wrote this. So, but I'm just showing that to you to show how you can increase your yield on something like that, even if it was yielding less than. But to show you how an intelligent investor can be even more intelligent and do and get some better yield. That's certainly a way to do it. But even if options aren't your thing, then maybe Starbucks wouldn't be your thing if if you're looking for yield. So at that point, if it's between Starbucks and like TLT, then and you're looking for yield, then that's an easy decision for you to make. And that again, I don't know your personal situation, so. You would have to kind of figure that out. But you can be an intelligent investor, whether you're using options or not. You can always learn more as well. And that's kind of what the point of this vlog or podcast or whatever you want to call it is going to be here at Dumb Dad, Poor Dad. We're dumb and poor. And so we're really, at that entry level with a lot of you guys. I've been looking at stocks since like maybe 2018. So it's about 5 years in it and still feel like there's a lot more to learn. That's where we're at with it. So I'm glad you guys took a chance to listen to this today. Leave some feedback in the comments.